Right. Happy Tuesday. Welcome to the show. We're half an hour away from the opening bell. Hong Kong, Shenzhen, and Shanghai. You're watching the China show. I'm David Ingles with Yvonne.
Our top stories this morning. Caution in the markets as investors await today's interest rate decisions in Japan and Australia. AI also in the spotlight with Nvidia unveiling its new processors.
Also ahead, China Evergrande accused of falsifying $78 billion of revenue with regulators banning founder Hui Kai-yen from the capital markets.
And I'm Stephen Engel outside the Bank of Japan headquarters here in Tokyo with reports the central bank is poised to end yield curve control as well as ETF buying today, as well, of course, as we reported yesterday, the hiking of its key rate for the first time in 17 years.
Here we go. Yes, we're taking a look at when it comes to that BOJ decision, likely going to be that top event risk here today. And really, you're seeing the market trading a bit sideways when it comes to stocks as well as currencies leading up to that decision, of course. But has it been all factored into equity markets? The yen, we really haven't seen that much movement in the yen, despite the number of reports that we've seen, the latest coming through from the Nikkei saying that, look, they could end yield curve control, ETF buying on Tuesday on the back of really that rate hike that's been widely expected now, more like consensus more than anything. A50 futures, though, in China, we're still on the back foot here. RBA had a decision maybe before or after the BOJ. We don't know yet, of course. And then, of course, the Fed starts its two-day meeting today as well. You take a look at how Japan assets are faring. So it's interesting. I think some 90% of economists believe something could happen, right? There's a big chance of that. Nikkei futures, or Nikkei is a back foot about 0.5%. Not a whole lot of movement when it comes to stocks. Dollar yen, I think we're on a 6th day of losses for the currency at 149. We're getting close to 150 than 140 at this point. And yield's not really doing a whole lot here today. So certainly that's the one to watch here. And really, the focus now is what's going to be the pace of further hikes, if in fact they do make a move here today. And of course, what does it mean for bond buying? Bonds are doing this here right now. Obviously, we've been tracking the 2-year and the 5-year briefly hit those 2024 highs. I believe the 5-year is still there. Basically, that June call for a cut from the Fed is now less than a coin toss. So less than 50% odds. You have Goldman also now switching their view and saying fewer Fed cuts this year. RBA, we're still seeing yields take a little bit higher here. They're set to hold, but keep in mind, last statement, they did keep that rate hike on the table as well. So we'll see what the commentary suggests. We're 4 basis points lower for your Chinese 10-year yield, so that's quite a movement when it comes to CGBs this morning. And you're watching the dollar. I think we're on a 4th day of gains for the greenback here. So you're seeing a bit of a back foot when it comes to European currencies. You have the Aussie is slightly on the back foot as well, and 720 for dollar China. Commodities, though, that's where a lot of price action has been put in place. You take a look at where oil is right now. We're back to October highs when it comes to WTI. This one talks about Russian oil refining capacity. That's certainly keeping the price of oil elevated. You have crude on course for a 3rd monthly climb as well there, Dave. Copper is at 11-month highs. Iron ore, though, we're still seeing a bid here this morning despite the downtrend.
So we're looking at some of the energy plays as we approach the open today in China. Jiangxi Copper, give or take, of course, given what's been happening in the copper market there as well. A couple of things on the agenda today. So these accusations on Evergrande, we talked about that, more on that in a bit. Just keep in mind, the actual stock is still suspended here in Hong Kong. Stock Connect closed both ways, have been picking up. I think we're 4th day of net buying into China. In fact, on the CSI 300, 4-month highs in that. Momentum is there. You're getting the RSI at about 70. We're also watching the second reading, which is taking place, I believe, right now, Article 23 here in Hong Kong. Keep your eye on that, amongst many other things, of course. And by the way, we haven't even talked about earnings, everything from Xiaomi. Ping An, I believe, is also coming up. Ping An Healthcare, to be more specific, is coming out with earnings today. So keep your eye on that. A preview is coming. And, of course, the big drop overnight in Li Auto, so we're looking at that. Then XPeng, since I talked about earnings, is also coming out with earnings here as well. But anyway, we're the China show, but we're talking about Japan today. Why not?
You have to, right? This is still the biggest event today. Let's get to that meeting coming up in just a few hours or so. Our chief North Asia correspondent, Stephen Engel, is live outside the BOJ in Tokyo. Steve, we're finally here. How's it feeling so far this morning?
Yeah, Yeah, we're just waiting for liftoff, right? It is something that's been brewing and pretty much a foregone conclusion after the local media, the Nikkei and others had reported that essentially the Bank of Japan will exit negative interest rate policy for the first time in 17 years. Later today with that announcement, expecting about a 10 basis point hike in rates to a range of 0 to 0.1%. Not a big bazooka bang, but again, it is monumental, I should say, because it hasn't happened in nearly 2 decades, and it is a return to normalization, perhaps, as well as what the Nikkei is reporting, that it could include as well a scrapping of the yield curve control, as well as new purchases of ETFs and J-REITs. Now, we can break down the significance of that. Obviously, with yield curve control, there was lots of bond buying, aggressive bond buying of the JGBs. Now, because Governor Ueda wants to remain and keep an accommodative, stance and not take stimulus out prematurely, they will likely continue, as we just heard in the last hour from the chief Japan strategist Ria Nakamura, essentially saying, they will continue to be buying. That's what they're going to be waiting for, to see what is the next policy as far as bond purchases of JGBs, to keep it at a stable level still, despite scrapping of the YCC. And what level is that going to be going forward? Now, as far as ETFs, they haven't been very aggressive in purchasing exchange-traded funds or even J-REITs over the last few years, which were put into place really as a backstop for the equity markets. The ETF mechanisms put in place since 2010. But they've been dialing back on that. The key question going forward now is, if they do indeed scrap that program, is will they continue to hold existing holdings, right? Just not add to it. So there's a lot to consider as we hear from, of course, the policy address coming midday, and then again the press conference later from Governor Ueda at about 3:30 local time.
Yeah, Steve, I was going to ask you about the press briefing, because I mean, yeah, fine, they're going to hike rates. They're going to hike rates to just above zero, so practically still not an interest rate in Japan. And the reason I bring that up is, what do you think the pushback might be from Ueda, just to manage expectations in this market, that they're not actually headed towards aggressive tightening at this point?
Right. I think he's going to pretty much state the current situation as of right now. And that's why they've made this decision now, especially after those wage price gains, essentially, the wage negotiations, the shunto, the annual spring negotiations that led to, of course, what we heard on Friday as well, with the biggest federation of labor groups, Rengo, announcing far better wage results of 5.28%, at least in the first round. We were expecting about 4.1%, and well on top of last year's gains, which were the highest in 30 years, of 3.8%. So that indicates to Governor Ueda that there is a virtuous cycle of inflation backed by wages. But again, there's been past mistakes, and we've all documented this, of the Bank of Japan withdrawing stimulus too prematurely and then getting the political blowback from that. And again, we've been in this vicious cycle of deflation for decades now. So again, he's going to be very dovish. He's not going to say what he's going to do. I'm guessing here. He's not going to say future hikes, even though many are saying that perhaps it's one and done, maybe 2 this year, pause, see how it works through the economy, and then maybe resume hiking in 2025. But he's not going to telegraph that. He's going to say the conditions right now.
Steve, it's going to come in hot, so keep warm. There we go. Stephen Engel, our Chief North Asia Correspondent, live for us outside the Bank of Japan in Tokyo. Let's bring in Ed Cole, Head of Multi-Asset Strategy Equities at Man Group, joins us here in the region, in fact, here in the city on set. Nice to see you. Good morning.
Thanks for having me.
How are you looking at Japan right now?
I think your correspondent put it well. Yes, they're going to move. I think we have to be clear that quantum's probably tiny.
Okay.
Real interest rates remain negative. The balance sheet's big. I think the Bank of Japan intends to continue to be accommodative, and I think that's the key message here. Markets embrace hysteria, right? So everyone's fixated on what happens today, what it means, what do equities do, what does the yen do. I think we have to take a step backwards and think about the big picture. And the big picture is that it's been a decade and a half since rates have been increased. They are starting to see some stickiness in inflation. It seems very unlikely that the policymakers want to move in any way aggressively to stamp that out. So I think kind of, a cautious approach to normalizing is the watchword here.
And what does that mean for equities then? I mean, has this been largely priced in? We can focus on this big rally that we've seen in the start of last year? I
mean, look, I think there's always a risk of travel and arrive in markets when you have these sort of singular events that people focus on. The rally has been ferocious. Year to date, it's been ferocious as well. We actually think the big picture here is about something much more than central bank policy. It's about the corporate governance revolution. I think the thing that is multi-generational here is the organic effort almost by Japanese companies to start to normalize their balance sheets, their own balance sheets, and start to raise ROE and deal with all the inefficiency in the way that capital is allocated. You've seen that right across the spectrum. You've seen some fitful starts from some of the bigger companies. There are still some phenomenal anomalies, some incredible inefficiencies, and there's a lot of opportunity there, I think, for companies to continue to normalize. What I mean by normalizing is this reduction of cross-shareholdings, principally, that can allow companies to free up balance sheet capital, pay it back to shareholders, make acquisitions, do sensible things with it other than just park it in their customers or their suppliers.
It's a good point you bring up. Almost the BOJ might just be a symptom of all the underlying changes taking place in Japan. And I'm wondering at this point in the rally, ferocious as you put it, what metrics would you be looking at to just screen the proper winners, potential winners from here on?
Yeah, I mean, look, we tend to look at Japan from a value perspective. We're value investors when it comes to Japan. That at times is quite difficult. There are periods when value does very poorly. I think year to date it's been quite interesting because you've had a kind of an environment where a lot of what's moved in Japan has been associated with what's going on in the US. So the kind of AI periphery has been very resilient, very robust. I think the opportunity here, if I'm right, that corporate governance has got scope to continue to drive equity returns, you really have a lot of opportunity to be looking outside the obvious big cap names into mid-cap value. That's in particular what we think is interesting. That's where you have a large swathe of companies that have not yet necessarily addressed the reform that they can do, the restructuring they can do to their balance sheets. The other angle on all of this, having said we need to not be fixated with policy, I'm going to bring it back to policy. We do have to be clear that the yen is incredibly cheap, right? If you look at it on a PPP adjusted basis, it's incredibly cheap, maybe almost record cheap. At some point, I mean, it's conceivable that if we have the Fed cutting and the Bank of Japan hiking for, I think, the first time in over 3 decades, that might be something that starts to see some appreciation of the yen. It would be likely there's a sort of reflexive action from equity participants to think that's bad for Japanese equities. We're just not that convinced that's necessarily the case. I mean, it's possible that a lot of the relationship between dollar-yen and equities over the last 15 years post-GFC has been entirely in a disinflationary environment, right? One where we just haven't had nominal GDP growth to drive equities higher. There were periods, certainly before the GFC, where the yen was strong and equities were strong. 2002 to 2006, I think in particular, when Japan, actually the latter part of that, Japan was going through a period of quite robust economic activity. So I think we have to be open-minded. It's possible that actually if we see the yen rallying because Japanese nominal growth is in a stronger position, then that might not be a bad thing for equities. It would be one where you'd want to be in domestic equities more than exporters, that's for sure. Yeah. And that's part of what I think we can find in the mid-cap space.
I mean, you take a look at what the U.S. and the Japan bank is doing, the central bank is doing, it seems like rates are on opposite sides of the spectrum. But you argue there is actually some convergence here. Can you explain that?
Yeah, I think sort of convergence in philosophy, not convergence in rates. Obviously, one's at 0, there or thereabouts, one's at 5. They're at opposite ends of the policy rate spectrum. What I mean by that is that what my impression is what both central banks are telling us is that they're prepared to be accommodative. So Bank of Japan is happy to be accommodative because interest rates are negative too. So they're telling us that they probably intend to start to normalize, but do it very, very slowly. And the reason to do it slowly is not to derail this nascent inflation that actually is beneficial for the first time. Look at what's going on in wages, right? That's phenomenal. This is what Japan needs. So don't stamp that out early. Allow nominal GDP growth to run a bit hot. That gets things moving in the domestic economy. It also helps with debt, right? Public debt to GDP is over 200% in Japan, so it's helpful. If you can have higher nominal GDP, you can inflate away that debt. How in any way can that be similar to the US? Well, in my mind, although the Fed tells us that policy is restrictive in the US, everything that's going on in all these speculative assets, in gold prices, in Bitcoin, in crypto, all of those things tell me that the policy is not accommodative. Sorry, is not restrictive. It is accommodative. There's a lot of liquidity available in US markets. I think we can see that now. The tendency for the most speculative elements of the capital markets to be kind of endorsing that sense that we had back in late 21 of euphoria is really present. That suggests to me that real rates are not restrictive in the US. And the Fed's telling you at that moment in time that they're prepared to think about cutting rates. So two central banks at opposite ends of the spectrum on policy rates, but both of them prepared to tolerate expansive policy. Again, I don't think the Fed's ever going to tell us what I'm about to say, but I think the benefit in the US is that if you run the economy a bit hot, there's two benefits. One is it has been disinflationary in the US since the GFC, and you want to exit that period. And two, as a corollary of that, is that through higher nominal GDP, you can help inflate away your debt.
Ed, we'll have more with Ed. I hope you can stick around. We still haven't talked about this U.S. market as well. Ed Cole, head of multi-strategy equities at Bain Group. He's staying with us. Still ahead, we'll discuss where the opportunities are in the private equity space in China and Japan. We have Jonathan Jiaju, Bain Capital partner, joining us later on this hour.
But ahead of that, though, we're talking this news on Evergrande's accused of, falsely inflating its sales by, get this, nearly $80 billion, and much of the blame is being laid now on the founder Hui Kai-yen. Details on that story coming up. The opening bell 13 minutes away, Shanghai, Shenzhen, and here in Hong Kong. We'll leave you with pictures out of Hong Kong and the LegCo here. LegCo lawmakers are holding the second reading for this domestic national security bill, Article 23. More details ahead. This is the China Show. Right, welcome back to shows. We're still talking markets here. We've covered Japan. We've covered other things. We're still talking to U.S. here. Ed Cole joins us, still head of multi-strategy equities at Bain Group. Talk to us about U.S. equity markets. Nvidia gave us something to think about. Don't look away now. How are you thinking about U.S. equities?
I think that's the key. That's the core of it. So I think if you take a step back, there's a lot of conversation about whether or not we're in a bubble in the US. I think traditionally bubbles have very, very high multiples, and that's just not evident today. The US is kind of mid-20s price earnings multiple. The Nifty 50, I think, was 45. The .com was 60. The Japan bubble was 70 plus. So we're a long way away from the type of valuation that suggests we're in bubble territory. What is interesting, the measure that's starting to suggest to me that animal spirits are getting pretty kind of aggressive is the long-term measures of earnings growth in the IT sector, and that's why your comment on Nvidia is so relevant. If you look at the 3 to 5 year consensus earnings growth integer or earnings growth measure for US IT sector, it's growing at about 25% annualized. So the market analysts are expecting 25% annualized growth for the next 5 years in IT. It's only been higher ever in the .com bubble. Right? So we're getting to that point in the cycle where there's so much belief from the analytical community that they're starting to reflect really dramatic, sort of almost unprecedented growth in earnings. And it's being fed by things like happened last night with the announcement of a new processor. I guess I suppose I'm watchful for the fact that we're starting to have bubbly type behavior. I don't believe we're yet in bubbly type valuation. I do think it's worth, we come back to the conversation we were just having about policy. Think about what it means if the Fed starts to ease monetary policy when nominal GDP growth is running at 7%.
What would be the narrative then if it does cut? Is it risk positive? Is it dollar weakness?
I mean, I think the first thing to say is that policymakers, so Christopher Waller, who has been a pretty reliable guide of Fed sentiment, said about 3 weeks ago that the Fed isn't looking at stocks when it thinks about policy. So the first thing they're telling us is they don't really, they're not bothered if the stock market's doing what it's doing. I think we can all get hung up on the quantum of cuts, and for me, I'm not really that interested in whether it's June or later, and I'm not really that concerned by how many they do. It's more about the sentiment that they don't intend to tighten here while policy seems to be expansive. In my view, if they're cutting rate or they're signaling they're cutting rates this year, we probably see a continuation of kind of leadership. What do I mean by that? I mean, we've done some analysis looking at cross-sectional momentum in previous trending bull markets. That's a measure of basically winners versus losers, right? It's a market-neutral measure. It's been incredibly robust year to date. So every investment bank can show you their measure of momentum. In the US, it's up 20% year to date, which is the best start, I think, for the last 15 years at least. My sense is if the Fed starts to signal easier policy or carries through on its signal towards easier policy and is doing that against a backdrop of nominal GDP growth at like 7%, policy not that restrictive, hence what's going on in speculative assets, that we probably are going to see momentum start to work much better. The last 5 years annualized, it's been 0. So we've had a really tricky environment. There's been a lot of rotation, a lot of leadership change, and I think we'll see less of that.
5 seconds left.
Yes.
How are you looking at China now? Just 5 seconds.
I mean, very interesting opportunities, really. I think there's a lot of hyperbole in the way people talk about it. But I think the interesting thing we can see is some important stimulus measures, particularly on the consumer side, and some good opportunity in consumer stocks.
And you're seeing a rotation out of India into China, which is quite interesting as well.
That's what our team's doing.
Ed, it's great to have you in the region. Ed Cole there, head of multi-strategy equities at Man Group, joining us here in Hong Kong. Futures are looking like this here right now. Your pre-market in Hong Kong just opening up. We talked about the second reading of that Article 23 that's in play here right now. We are seeing this market slightly lower here this morning, down about 0.6%. This is Bloomberg.
All right, so we're looking at some weakness going into the open today. Hong Kong gauges, of course, slightly down here, although in terms of momentum, when you look at what's happening onshore and really 4 days of inflows there, we're testing the 200-day moving average and the CSI 300. There's some momentum really coming through, in fact, very strong momentum. Every single sector is up from that bottom on the index. Watch it closely. And ahead of the open, we're looking at EVs. Lots of stories there. XPeng's coming out with earnings. There's a big drop in Li Auto overnight. And a look really at how some of those things are moving ahead of the open. 3 minutes away, you're watching the China Show.
Welcome back. You're watching the China Show. We're counting down the open of markets here right now. Just about 40 seconds to go. We are seeing the Hong Kong pre-market area slightly to the downside, about 0.6%. We talked about that Article 23 second reading that could be happening or could be going through quite swiftly here. So certainly that's one to watch. If futures have been negative for the most part. I mean, most of the market is basically kind of on tenterhooks about what's going to happen with BOJ. We have the Fed starting that 2-day meeting as well. So not a whole lot of risk on the table here, and bond markets continuing to price in the possibility of higher for longer, Dave.
Yeah, year-to-date highs, and I think the 2 and the
5
on the 5-year there, and there you go. And there's also the RBA, which might actually come. Could it come out at the same time as the BOJ?
Who knows?
We have a poll.
Make the show interesting, huh?
We have a poll that's taking place in the newsroom. You guys can join, actually. I won't tell you.
Said, "Is this the March Madness for Bloomberg TV in Asia? When the BOJ is going to move and what time?"
Well,
we always bet that, though.
Markets are on offer ahead of those critical central bank decisions. 1.2% weakness. Most sectors are down. Most benchmarks are down. Weakness coming through in the currency. Your 10-year yield in China. Get this. Check that out. We're below 2.3% on the 10-year. Wow. Okay, there we go. So 200-day moving average is perhaps in focus today. We perhaps don't get there given price action as we speak. Earnings are very much in focus today. So you have XPeng, you have Xiaomi coming out with earnings today. In terms of sector groups, and while I talk about this, flip the boards, please. You have energy because oil's at 4-month highs, copper's at 9-month highs, resources in focus, Jiangxi Copper, hence we're giving some real estate on our board today. Li Auto's down about 7%. I think we're down about 11-12% overnight. There's support talking about how orders were disappointing for its mega model. That's really playing out. And of course, Xiaomi, as you can see, 0.5% there, lower there as well. Okay, there we go.
Let's get to one of our top stories here this morning in China. Defaulted Chinese property developer Evergrande has been accused of falsely inflating its revenue by more than $78 billion in the 2 years leading up to its failure. For more, let's bring in our Greater China senior executive editor. I should bring in Loretta Chen, our China credit reporter, joining us for more on this story. First of all, tell us just how significant this is and how widespread is it throughout the company itself?
Yeah, so what happens was the company and also its founder, Hui Ka-yen, was charged with this massive fraud, basically by inflating their value of total almost $80 billion over the past 2 years leading up to its default in 2021. Hui Ka-yen was fined 47 million yuan. That's actually a very significant number in China's CSRC history. It's one of the biggest fines that we've ever seen. Hui himself has been under police control under some unknown criminal charges. So this CSRC charge is on top of those criminal charges that we have yet to know. That's facing the company, and then on the other hand, you would have the liquidators of Evergrande really pressing a potential charge against the company's auditor, which is PwC. And I think with the latest CSRC findings, it could potentially help these liquidators in terms of pressing their charges in the Hong Kong court.
Okay, so what's next?
Well, I mean, it's really cementing the downfall of the once the biggest real estate company in China. And so, I mean, of course, Chinese authority wants to make an example of Evergrande and its founder. And it's pretty clear that Hui not only faces the security charges, but also the criminal charges. I think for the other smaller developers that were probably following similar practices in past years, they would also be, alarmed with this move by the CSRC, and potentially more could follow, because we know Evergrande was the bad boy of China's property crisis, but it definitely isn't alone in inflating its revenues.
All right, Loretta. Thank you, Loretta Chen, our China credit reporter, with the latest when it comes to Evergrande. Let's go back to broader markets and bring in our executive editor for Asian markets, Paul Dobson. He's in town. It's good to see you, Paul, back in Hong Kong. What's your team watching out for here today? I mean, BOJ, I'm guessing, is top of mind.
Yeah, it's impossible to ignore the BOJ. Lots of focus on there. Whether it will have a huge market impact or not kind of remains to be seen, because so much is already priced in, I think, at this point, which is good from the BOJ's perspective. They'll want to be able to do this without ruffling any feathers. And, they may even choose to give a strong signal but wait another month in order to do that. But I think the odds seem pretty set on them moving this month, lifting interest rates from the negative territory, probably abandoning the yield curve control and giving up on the purchases of ETFs that would support the stock market as well. So removing a little bit of the safety net, letting the markets fend for themselves, letting the economy fend for itself a little bit. I think what investors really want to hear, though, is, are we just going to get back to ground level and then stay there, or are we going to be able to carry on going a little bit higher afterwards? What does this look like in terms of a rate path trajectory? Yeah. Is it trajectory? Sorry, is it going to be a series of rate hikes, or is it going to be one and done?
Let's talk about China, and what a day, certainly for the BOJ to take the spotlight. There's really been some momentum coming through in equity markets in China. How's your team looking at this today?
Yeah, well, it's interesting, and we're seeing more and more sort of the global funds that have been staying away coming back off the sidelines, sort of talking up the prospects of China, either from the perspective that it's incredibly cheap right now, or from the perspective that actually there are signs of a bit of a turnaround. I think, the data yesterday was very mixed, right? We had the good industrial numbers, manufacturing looking strong, but the domestic consumption picture is still very gloomy, and that's why, you were getting excited about the 10-year bond yield. That's why the market is pricing in those very, very lower for longer kind of levels. I think that the market feels that the policy level needs to stay supportive for a lot longer in order to help everything else to turn around. I feel like, if you're a super long-term investor, you can argue that there's going to be some really good stuff happening, but that it's going to take a long time to kind of foment and come through.
What was also supposed to happen this week was the Fed was supposed to be cutting rates. And now it doesn't seem like June is even base case right now. The good thing, it seems, is that equity markets have learned to live without rate cut expectation, at least getting priced back.
Yeah. Which is in the one hand, you can see it because the economy still looks strong, right? The Fed, even at these rates, Fed doesn't seem to be very restrictive, okay? But it does also seem to be minded to want to cut interest rates at some point. So with those two things playing out, then of course, there's plenty of liquidity around as well. The market can continue to sort of feel supported. But at the same time, it's kind of worrying how much enthusiasm there is for this kind of AI theme in particular, but the sort of general everything rally, and whether that's starting to mask some of the risks that are out there, not least commercial real estate, but also the idea that inflation just remains sticky and that policy rates need to, if anything, go higher rather than lower from here.
All right, Paul, great to have you. Paul Dobson there, our executive editor for Asia Markets, joining us here in Hong Kong. And we're looking at live pictures here right now of LegCo here in the city as lawmakers are going through the second reading for Article 23. We got plenty more ahead. This is Bloomberg.
Right, welcome back to shows. We're looking at a couple of things here. So, losses are actually picking up in the public markets about 8 minutes into the session. We'll revisit that in a moment. We'll pivot to private equity right now. And certainly just have a look at some of the data that's coming through here. So this is really a look over the last, 6 years or so. Number of deals has come down. Private equities, of course, in orange. It's picked up slightly, of course, towards the end of last year. Let's get a sense of trajectory and where things go. This is a global, by the way, and get a sense of where we go region-wise. Jonathan Jiaju is here with us and set partner and co-head of Asia Private Equity at Bain Capital. Good morning. It's nice to see you.
Good morning.
Have things been busy? Busier? Not as busy?
Well, I think activity levels are pretty good. We had a good year last year both from a capital deployment point of view, doing new deals, but also from a liquidity point of view. And coming into the new year, I think things continue to look pretty good.
How do you look at deal making now? Are you seeing a significant pickup in the next coming quarters or so?
I think obviously, we cover a pretty broad swath of territory. We cover the entire Asia-Pacific region, and there are a lot of differences. I think when we started to invest in Asia, we deliberately crafted a pan-Asian strategy so that we can pivot to areas where things are more attractive. And I think if we look back at 2023, for example, I think India and Japan were very strong, were very, very hot. China was more difficult. I think looking into this year, we continue to see strong deal activity in Japan and in India. But also, we're also beginning to see interesting opportunities in China as well.
Such as?
We have been focused on, I think, 4 broad themes in China. I think when we compared to China to 2 decades ago when we started investing, I think there are 2 big differences. On the one side, the growth is certainly much, much lower, right? Because back then we were seeing double-digit nominal GDP growth rates, so everything was growing. Today, it's a very, very different environment. But on the other hand, after so many years of rapid growth, China today has scale in a way that was almost unimaginable back then. In 2006, when we started investing in China, per capita GDP was about $2,000. Last year, it was almost $13,000. So that level of wealth increase, income increase, creates scale opportunities. The second thing that's different is that actually, the level of sophistication, technological sophistication, geographic footprint has also increased pretty dramatically. Back then, it was very difficult to find mature businesses to invest in. Today, these opportunities are much more common.
I mean, valuations have been low in China. Do you see a floor or a bottom being formed here? I mean, we haven't seen a significant pickup in activities either.
Yeah, no, I think when in the private, unlike in public markets, right, when prices are set every day and trades are happening all the time. In the private market, this is a little bit. There is always a period of adjustment. When valuations decline, I think sellers would be very reluctant to sell, and buyers would be very reluctant to pay yesterday's prices. So there's usually a period of adjustment, and I think we are probably seeing that adjustment ending. That people are beginning to realize that the values that we see today are probably the right value, and so I would actually see deal volumes pick up from here.
You're in a very unique perspective. As you mentioned, you've been investing in China for 20 years, and I'm curious how the recent changes in just the geopolitical rumblings have affected, well, for one, has the investable universe narrowed for you because of, I guess to some extent, the second part of the question is what are global LPs and how they're looking, and what exposure do they want in China and what exposure do they not want in China?
Right. I think first in terms of deal opportunities, I think certainly the more complicated geopolitical environment makes deal doing more difficult. I say, when we look at investing in China, we look through 3 different screens. We need to look at business fundamentals, economic cycles. So that's one screen. We need to look at Chinese government policy priorities. That's the second screen. But then we also need to look at geopolitics. For example, the U.S. government has imposed restrictions on investment in certain areas like, advanced computing, AI, semiconductors. So then those make it more difficult for us to engage in. So the field, if you will, has narrowed. But as I say, on the other hand, the scale has become bigger. Right. So the opportunities are still there. So that's the second part of your question in terms of global LPs. I think LPs are very different, right? We have LPs from all over the world. We have obviously North American LPs, European LPs, but also Asian LPs. So with them, we see differences in terms of preferences. Some LPs are more cautious on China. Some LPs are actually more inclined to invest in China given today's valuation environment.
You mentioned a dilemma around tech, just given the political environment. I'm just wondering, it seems like a lot of U.S.-based PE firms are not really investing in tech in China right now. But you take a look at the innovation there, as you mentioned, it's getting more sophisticated and it's proliferating. Is that going to be something to be a bit of a missed opportunity for a lot of U.S.-based PE firms?
Yeah, I think, again, we need to probably look a little bit one level deeper. Tech is a very, very broad category. When we talk about tech, obviously, semiconductor, AI is tech. And I think for a U.S.-based GP investing in Chinese semiconductor and AI is going to be difficult because of government restrictions. But there are all kinds of other techs. There is China has actually made a lot of progress in industrial tech. Robotics, for example, batteries, EV. So those areas are still very much open for investment, and we are very interested in looking for opportunities there.
You mentioned other markets, India, Japan. What else is busy for you guys? What else do you think is going to be picking up substantially this year?
Yeah, so I think in addition to, we have a broad regional strategy, and we try to find investment opportunities in India, Japan, China, Australia, Korea, and Southeast Asia, so across the entire region. And in every fund, we have invested in all of these markets. Last year, for example, we deployed capital in Japan, in China, in India, and in Australia. And currently, we're looking at multiple deal opportunities in Korea. So I think what we see is actually pretty broad-based deal flow.
And is the split equal? I mean, how do you look at it in your latest fund? You have a $7 billion fund that's out. What's the geographical split now?
The split is, we don't have a predetermined split going into investing a new fund because it is always very difficult to do those kind of allocation because opportunities will come sometimes from unexpected areas. For us, we find Japan very interesting. We've been interested in Japan over the last 20 years, and today we have the biggest team in Japan. If we look at the last two funds, 3 and 4, we've deployed close to 40% of the last two funds in Japan, and I think right now it looks like that would continue. I think China and India are roughly the same, although given the current excitement about India and the current deal flow in India, that could change a bit.
All right, we're going to leave it there. Jonathan, thank you so much. Jonathan Jiaju there, partner and co-head of Asia Private Equity at Bain Capital. We're taking a look when it comes to this risk-off session that we're seeing across markets where stocks as well as bonds are falling. Asia FX is also on the back foot with the strength of the dollar coming back here today, but CSI 300, we're down about a third of 1%. You're seeing mostly in the offshore markets with Hang Seng down more than 1%, along with HS Tech. This is Bloomberg.
All right, welcome back. Substantial rally is taking place in the CGB market and this is a move you don't normally see, 4 basis points in the 10 years, so we're back below 2.3, and you know what, we're retesting these levels we hit a couple of, I would say 2 weeks back. Below that, you know what, those record lows are very much in sight. We'll see what happens here, Yvonne.
Oh, yeah. So definitely you're seeing that rotation back into the bond markets. So just given what we're seeing across equities today. Let's get to another story and focus a little bit more on the solar industry. Bloomberg has learned that China's Longi green energy technology plans to cut as much as 30% of its workforce. The company denies that, saying around 5% of roles will be affected. Let's get to our Dan Murtaugh, our Asia energy reporter, joining us now more on this scoop. Just tell us a bit more about what your team is learning about this story here, Dan.
Yeah, well, this has been a remarkable turnaround for the world's largest solar manufacturer. When it listed in the Shanghai Stock Exchange in 2012, it had about 4,000 employees, and it just grew and grew and grew as the industry expanded. And at its peak last year, it had about 80,000 employees. And now they're planning on cutting thousands. What we've been told by people who've been briefed by the management is the total layoffs could amount to as many as 30% of its peak workforce. It's already tried cost-cutting measures such as canceling free afternoon tea breaks and canceling free coffee at its Shanghai office. And so they're definitely trying to rein in costs. This is, to be clear, not a company that's on the brink. It has a massive cash and cash equivalents portfolio, according to its last financial filing. It's more of a sign of the overall struggles in the industry right now. Solar panel costs have fallen amid massive factory excess capacity, mostly here in China. And so while costs are low, companies are having to tighten their belt and buckle down to be able to make it through this period. But in the long term, most of these guys see a really bright future for solar. They want to be around for it, but they're just ready for a period, maybe this year, maybe the next 2 years, of really, really intense competition, lower profits, possible, mergers and bankruptcies coming up, and they're just looking to survive it.
Dan, so if the biggest one is going this route, and I know they're pushing back a little bit, of course, on the number, can and should we expect other players in the industry to also take this route of cutting costs when it comes to staffing?
Yeah. I think every company is going to be different on how much they've expanded, but across the industry, we've definitely seen that there's been a surge in capacity. The last that Bloomberg NEF, our wonderful analysis team, has looked at it. We're looking at global factories of nearly 1,000 gigawatts of capacity, and the world installed 441 gigawatts last year. Maybe we'll do more than 500 this year, which is incredible numbers compared to just a few years ago when it was just around 100. But at the same time, there's clearly too much capacity, and so some of this is going to have to be weeded out. Whether it's big companies like Longi laying off people and maybe closing some older, outdated factories, or smaller companies that aren't able to take the shrinking margins, having to get out altogether. One way or another, there's going to be a reckoning throughout this year.
Dan, great stuff in Beijing for us, Dan Murtaugh there on this, our scoop, of course, on Longi and the job cuts perhaps in the offing here. Okay, we're looking at, well, staying on green energy and really to some extent solar, XPeng, and we're looking at some of these EV plays. And XPeng's out with earnings, news out of Li Auto, of course, and reports that the mega model didn't, orders for such really disappointing, leading to losses right now, 7%. We were down 12% overnight. Wuxi AppTech, Wuxi Bio, it's an earnings story, plus, of course, broadly speaking, it's also the risk aversion out there. We're down across substantially on most. Benchmarks doing this. More in Hong Kong than in mainland China, although when it comes to mainland China, of course, we have been seeing a rally taking place. Now, all that being said, we are coming off lows today on the CSI 300 and also on the Hang Seng Index. So there we go.
And we got a big interview coming up, and you need to watch this one on Wednesday. We'll be here exclusively from the Philippines President Ferdinand Bongbong Marcos Jr. as tensions rise between Manila and Beijing in the South China Sea. So lots to ask the president about, not just the geopolitical tensions, but seriously what's going on as well. Water issues, economy, the like, too.
Yeah, inflation and certainly the key issues going into that as well. Now, coming up, we're still on BOJ watch. Perhaps in the next hour, possible, the BOJ looks set to deliver its first hike in 17 years. Former BOJ policy member joins us, Sayuri Shirai joins us. This is Bloomberg.
Welcome back. You're watching the China Show. It could be any minute, any hour now that we could be hearing from the Bank of Japan, of course, as they wrap up this meeting. And certainly the local media has been rampant when it comes to the headlines of what they could do. It looks like it's just ready for liftoff at this point when it comes to negative rates. Maybe some clues here on what it means when it comes to bond purchases, yield curve control, ETF purchases, the like. But yes, it's a big, big week, not just today.
Yeah. So possibly the BOJ, well, for sure the BOJ, possibly the RBA at about the same time as the BOJ. That depends, of course, on the folks in the BOJ building and really how quickly they can do a translation of the Japanese statement into English. And when that comes out, of course, any changes, that usually is perhaps what holds things along. And then we get into Wednesday where it's the Fed, of course, and really guidance in the dots and what that looks like as well, right? So all that takes place Thursday morning in Asia time, by the way, if you're talking about the Fed here. Lots on deck. In terms of bond markets, bond yields are back to year-to-date highs on the short end of the yield curve. Japan has been creeping up as well. The 10-year there is at about 0.76, 0.77. RBA and weakness certainly coming through in the currency as far as the RBA goes. We'll talk more about the RBA in just a moment. The global macro movers for you on your screens. It's generally risk-off across these markets. When you look at what's happening in bond markets, perhaps don't really see it as clearly on your screens. The Chinese 10-year yield, there we go at the bottom right now, is trading at about 2.28%, as we can see on the screens. There were 0.5% to the downside on the MSCI Asia Pacific. We're also getting a little bit of sideways trading as far as U.S. futures go. Just keep in mind, of course, we are coming off quite a strong session in the U.S. And also, before I forget, big moves in the commodity market. Oil is at 4-month highs. Copper is at 9-month highs, and iron ore was actually picking up, did pick up, is pulling back ever slightly today. There we go.
Yeah, let's bring in our team now. Stephen Ingles, he is outside the BOJ headquarters for us. Also joining us now is our Asia FX reporter, David Fitterty, and our economics reporter, Swati Pandey, who's watching the RBA as well. Steve, I'll start with you. It looks like this market has priced in the possibility of a move here today. What are you going to be looking out for in this press briefing with Rieta-san later on?
That's the interesting point because, again, everything else seems to be a foregone conclusion that they're going to exit the negative interest rate policy, according to the Nikkei and other news agencies, as well as the 2 o'clock in the morning story that came out from the Nikkei last night or early this morning that they're also going to scrap the yield curve control and also scrap new new ETF purchases as well as J-REITs. So the big question is, what news will we get? What kind of clarity and guidance will we get from Governor Ueda when he has that press conference at 3:30 local time here in Tokyo, in the building behind me, the BOJ headquarters? And again, if they're scrapping the yield curve control, essentially, what is going to be their bond purchase policy going forward with JGBs? Will they dial it back a little bit? Because, again, he still wants to maintain his constant narrative of accommodation. He wants to be accommodative to basically not pull away the stimulus too quickly, as the BOJ has a history of maybe prematurely withdrawing stimulus too quickly. And hence, we're in this situation we've been in, essentially, with negative rates for 17 years and deflation for more than a couple of decades, essentially. So again, we're going to have to read the tea leaves a little bit, because he's not going to telegraph future hikes. He's going to talk about the conditions right now and why, if the reports are true, why they're exiting negative interest rates right now. He's unlikely to say if it's going to be one or done, or there's going to be another one, perhaps, as Goldman says, in October, pause, and then wait until another year, 2025, for another hike. Again, we're getting speculative here, but again, we simply do not know exactly what he's going to say. Also on ETFs, of course, we're hearing from the Nikkei. The Nikkei is that they're going to stop future purchases of exchange-traded funds that they started back in 2010. Now, the key question here is, will they sell their existing holdings? Most likely not, again, because that would not fit in with the narrative that the Governor Ueda is likely to project, a dovish Ueda that we're expecting later today.
Swati, let me bring you in. Steve's gotten us all excited about the BOJ, over the BOJ. Can you get us equally excited, if not more, in the RBA in 90 minutes?
The Reserve Bank's decision is likely to be a non-event, if that gets you excited. We're expecting no change, so the interest rates will remain at 12-year high of 4.35%. One interesting thing that we are looking out for is whether they retain that tightening bias that they introduced in February, or they drop that sentence which says further interest rate increase cannot be ruled out. It will be very easy for them to drop that line from the statement if they did want to go that way, because data since their February meeting has been weak. Inflation has come off a boil. It is still above their 2 to 3% target, but it's moving in the right direction. Is that enough for them to signal that the tightening cycle is done? Is yet to be seen.
You know what, Swati, I don't blame you. It's hard for anything to beat the BOJ this hour, especially as well. I'll bring it to David Finnerty now, talking about the FX side of things. Let's bring it back to the BOJ, David, because everyone's wondering this lucrative carry trade that we have with the yen. What does it mean now if the BOJ is ready to lift off?
I think if we're honest, the carries trade still continues. I mean, if interest rates do rise from negative 0.1, should we say, to 0%, you're still going to, everyone's going to say, well, I'm happy to sell yen at 0% and invest the money somewhere else. So I think the carry trade still continues quite happily. As Stephen's indicated, the most important thing when you come to the BOJ is really, again, assuming they raise rates today, which is not 100% guaranteed, but certainly looks probable, is what do they signal going forward? And if they don't give any signal, then the markets will very quite happily go, well, that's not what we want to hear. We want, in this case, they want to hear rate hikes. So they don't get any indication that there will be more rate hikes. I think the yen's vulnerable to come under pressure today, particularly if the Fed does sound a bit more hawkish tomorrow in its dot plot. So it's quite interesting that you've had all this news come out today, and yet dollar yen's still above 149, despite news that, they'll scrap YCC, scrap everything. But having said that, if the yen's going to weaken, and interest rates will stay near 0%. From a carry trade perspective, you go, this is fantastic. I can basically sell yen, it's going to get weaker, stick it somewhere else, get a great return, and then unwind the trade. So I think the carries trade still becomes very attractive.
David, you mentioned the Fed. Talk to us a little bit more about that. Fine, we get the dots, and we're coming off expectations of 3, and now even June is perhaps not a base case in terms of that first cut. What's the risk to the dollar going into this meeting?
Yeah, I think the dot plot, there's actually a few things you need to look at the dot plot. So the first thing is obviously the rate cuts for this year. If you looked at the December dot plot, there was 11 people in the camp of saying 3 or more cuts. There was 8 in the camp of saying 2 or less cuts. So you just need 2 people to switch from the 3 camp to the 2 camp for that median dot to go to 2. If that happens, obviously that should put pressure on US yields to rise, which will be dollar supportive. If it stays at 3, because markets sort of love rate cuts, markets may go, oh, you've had strong data, Fed, yet you're still predicting 3. So they may go, that's actually good news. So you may see treasuries actually rally and US yields go lower on that news. That should be dollar negative. Now, having said that, you've also got to look at what's a dot plot for next year as well, and even more also for 2025 and beyond, over longer-term dots. Where is that R star that the Fed is saying? You are getting sticky inflation now. So the question is, not only will it impact the Fed's decision this year, does it impact the decision for how many rate cuts they predict next year and where they sort of see that end rate cuts ending? If that starts to drift higher, that dot plot, then obviously the market wants rate cuts, not rate hikes when it comes to the Fed. So at the end of the day, the market won't be happy on that. We'll have to dial back its expectations for Fed rate cuts. Again, that's basically yields go higher, dollar supportive. So at the moment, the dollar, every central bank in every currency is really at the mercy of where that dot plot goes.
I was going to ask you, in fact, I was going to ask you in China, and, is dollar China at 720 because of what the dollar is doing? And the equity market has picked up in China. The bond market is quite strong with CGBs, the 10-year yields at, I think, below 2.3%. And I'm wondering, why is the currency so weak, David?
I think, remember, the economy is still not fantastic. If you look at basically the yuan against a basket of currencies, it's been in a range now for the last few months, actually. So as far as China's concerned, actually, they could say, look, it's fair value. Remember, everything's been weak against the dollar, so you can't just pick on the yuan. If you look at the ringgit or the rupiah or other Asian currencies, they're all weak against the dollar as well. So Korean won, another one. So I think it's more you'd have to look at the yuan against the basket. I think what's interesting happens is if the dollar starts to rally based on that Fed dot plot, does the yuan weaken? Do they let the yuan weaken against the basket, or does the PBOC say, no, we're going to keep this range against the basket, which means it gains stronger against its peers, which is not good from an economic stimulus point, if we look at the exports and imports. So it's going to be interesting to see what the PBOC does, again, if the dollar gets stronger based off the dot plot.
All right. Team, thank you so much. Well, that was David Finnerty in Singapore Forex, our Asia FX reporter. Stephen Engel, of course, outside the BOJ. And out of Sydney, of course, 90 minutes away, just under that RBA decision, Swati Pandey there, our economics reporter. Still ahead here on the China Show, Hong Kong's new security bill is moving closer. Live pictures here at LegCo here in the city moves closer to being passed. An update coming up here.
Yep, but first, Nvidia unveils its new processor aimed at extending the firm's dominance of AI computing. We have details coming up next. This is Bloomberg.
This is Hopper. Hopper changed the world. This is Blackwell.
All right, the godfather of AI himself, Nvidia CEO Jensen Huang, speaking just a little bit yesterday at a company event here and showing off these new chips aimed at extending his dominance in the AI space. For more, let's bring in our tech reporter, Jane Lahi Lee, joining us in Taipei. Tell us a bit more. I mean, the market was a little bit disappointed by it, but we were expecting some sort of news of some new chip and the like. But what's interesting about this Blackwell?
I mean, this chip is multiple times faster, stronger than the last chip, the Hopper series of families of chips. And so the expectation is that companies, a lot of the top cloud companies like Google and Amazon and Microsoft will be buying these to, beef up their AI clouds. And the fact is, it's got, multiple times more transistors on it, which makes it work a lot faster, which is supposed to help with energy efficiency. So that means hopefully cheaper AI, although it'll still be expensive. These chips are monster expensive.
Yeah. Not for most of us, Jane. David here. So I think the question really
most of us can't afford it. I think some of them cost us like a car.
Yeah. Well, you got to head to the casino then to be able to afford one of these. I think that you underscore the point there, right? So, the main concern that people have when they look at Nvidia, particularly on valuations, is that it's a narrow base of very wealthy customers, right? That, those companies that are piling in and investing in data centers. And I'm wondering whether Blackwell or anything that was mentioned in that event addresses that concern. Does it allow Nvidia to expand its range of customers, I guess is my question here.
I can't really answer that. I mean, I don't have a crystal ball, but the fact is most AI models, the big ones, and the big companies use NVIDIA chips, and there is not really a competitor today. So if you want to get that power efficiency, if you want to move ahead, the big cloud companies are kind of still tied to NVIDIA. Part of that large moat that NVIDIA has isn't just that it has these super powerful GPU chips, these AI chips, but it has dominated the software ecosystem. So developers that make AI use a software platform called CUDA, which is what NVIDIA has invested a lot in. They made a big bet on this, and so they've tied up all these AI researchers and companies onto this platform, which works best with the NVIDIA chips. So until someone is able to crack that moat, NVIDIA will continue likely to dominate this market.
Yeah, despite the pricey chips, of course. There we go. We'll pass a hat around the newsroom. I'll pass it on to Taiwan, then you can pass it on somewhere else, and maybe we can afford together on aggregate, we can maybe buy a fraction of it. There we go. Jane Lan-Hee Lee, our Asia Tech reporter in Taipei for us. Trading on the expensive two CGBs, this rally is continuing when you look at the 10-year yield in China, although on the cheap, arguably, is the US 10, which is still holding above 4.3 to be more exact there. A little bit lower right now on the 10-year yields. Two central bank decisions, one possibly this hour is the BOJ, and then about 73 minutes or so is the RBA. So stay tuned for that. Bond markets are looking like this. If it's not obvious already, plenty more ahead. This is the China Show. Good morning, by the way. Welcome back. You're watching the China Show. We'll take you straight back to LegCo here in the city where the second reading is taking place. Of course, Article 23. For more context on what is happening right now, just in case you're joining us, and more context, broadly speaking, what this means, big picture, business, investments, and here in the city. Let's bring in Rebecca Chung-Wilkins, our Asia government and economy correspondent, joins us here to talk us through exactly what our viewers are looking at right now.
Well, we have this second reading of Article 23, and of course, just to put it into context, this has happened all incredibly quickly. If indeed it is passed today, which looks likely, so we'll have the third reading also today, and then it will be passed into law. If that happens, we'll have gone from start to finish in about 50 days. And typically, a legislation of this sort of complexity and this significance can take sort of months or years to actually go through this process. So it is happening very, very, very fast.
And how is the business community reacting to this so far?
Well, we're waiting to see a little bit more concrete reaction so far. But, I mean, of course, the whole issue of national security has become deeply sensitive as a topic to discuss. But we do hear, and people I speak to do express this sort of frustration with the Hong Kong government, somewhat seemingly relentless focus on national security at times. We know that the AmCham here, for example, their survey, the top answer in terms of what would improve US-Hong Kong relations was for both sides to just stop talking about national security. 2/3 of respondents asking for that. And it does look like that Beijing perhaps maybe also behind this sort of acceleration to sort of get this done and be over and done with this. We know that the delegates from the MPC, that's China's annual parliament, hurried back to Hong Kong to initiate this process. And we have, throughout this, have seen this sort of unprecedented pace of getting this through, sort of impromptu, unscheduled meetings that have been booked in order to discuss this legislation and debate this legislation.
Well, how has the government addressed these concerns? What's their pushback been to some of these worries?
Well, they say, and sort of rightfully so, that Article 23, of course, was mandated as part of the mini-constitution of Hong Kong. So this, from the outset, really has been the sort of prerogative of government to try and usher through this some form of national security law. And in some ways, it doesn't diverge hugely from the Beijing national security law that was imposed in the wake of the protest back in 2019. And so I think for some in the city, this isn't sort of a huge watershed moment. It isn't a massive change per se. They've already recalibrated to the reality itself. I think there will be some focus on what precisely the amendments that we see. There was, for example, positive response to the addition of this sort of public interest defence when it comes to this law. But because there isn't that much sort of reference per se, the discussions that are actually being had in LegGo today, the debates that are being had in LegGo today will be important reference points for when and if Article 23 cases come through. Lawyers, judges and so on will refer back to these debates.
All right, Rebecca. Thank you. Rebecca Chung-Wilkins there. On Article 23, and we'll bring you up to speed here once we do get any more clarity on this reading in LegGo. Of course, you can get an insider's guide to the money and the people shaking up the finance hub in our new Hong Kong edition newsletter that's out every Thursday. You can sign up through the website, bloomberg.com/newsletters. And on Wednesday, you don't want to miss this one. Bloomberg News is going to bring you the first ever China Credit Forum, looking at the new risks and opportunities that are emerging. It's not just Bloomberg News, right? We're going to be part of it, right, Dave? We're bringing the show to the forum.
We're taking the show out of the studio for the first time. So we're somewhat on the road, a little bit of an out of Africa moment. So this time tomorrow, you guys are in for a visual, not only a visual treat, of course, we're really going to go deep into a lot of the key issues and, the malaise in the credit market and the offshore credit market. And by the way, fantastic kudos to our team who are putting this together. This is really where we're taking place here. And we're doing live interviews on site. We're going to have a fantastic set of speakers to really get a sense of, well, is the worst behind us? What lessons have we learned? Where is there value right now to be? Is there enough information to act on all this information? And also, it's also taking place timing-wise with, the news on Bangkok, for example, right?
Yeah, and what is the troubles around this developer? What could it mean, right? If it's in trouble, does it send another shock to this housing market? Is it bearable? Certainly is one thing that we're going to be asking a lot of these guests as well. But everyone from Bain, we have Invesco, Fidelity, BNP Paribas, they'll all be joining us. I'm doing a panel on LGFVs.
Yep.
What are you going to be talking more about?
We're doing something on, the offshore bond market, the opportunities, right? So we have, Value Partners is joining us, ANZ. We're also talking, away from the bond market itself, we're also talking loans, right? So what is appetite right now for issuers right now to issue these kinds of debt and to really take on all the debt, given, of course, the cyclicality element also of this market. So, 2 hours of goodness coming up.
So definitely check out the top of the show here tomorrow. Live Go, you're going to see the whole thing take place, of course, with the China Credit Forum.
Okay, very quickly, we're about an hour into the cash market session here. Energy stocks in focus. Oil is at 4-month highs. You're also seeing a pickup in some of the oil contracts traded in Shanghai. So this is really across the region itself. You have, of course, PetroChina in there, S-Oil's Korea, CNOOC is China, Inpex is Japan. So we're going into the lunch break over in Japan. Consumer finance companies. Okay, this is interesting, and I'm just going to bring up the piece of news here why we're looking at some of these things as well. So China's raising requirements for consumer finance companies to prevent financial risk. It's according to a document issued from the National Financial Regulatory admin late on Monday. So it's raising the minimum for registered capital for these companies to about 1 billion renminbi. Declines across some of these names, and of course we were just talking about Nvidia earlier on.
Yeah, so you're starting to see some of these chip stocks. Obviously, with the disappointment with the Nvidia stock, I mean, everyone knew there was going to be a new chip, but I guess maybe some of these new details was sort of a sell the stock sort of moment. So that's why you're seeing the likes of SK Hynix down some 3%. TSMC is slightly to the downside, but Hitachi, Singtel, they did announce some news here with Singtel to introduce those GPUs from Nvidia in the third quarter, and a GPU as a service with that company. Hitachi also talking about a partnership with the company as well. So certainly some good and bad news on that front when it comes to AI. Plenty more to come. This is Bloomberg.
We tend to look at Japan from a value perspective. We're value investors when it comes to Japan. That at times is quite difficult. There are periods when value does very poorly. You really have a lot of opportunity to be looking outside the obvious big cap names into mid-cap value. That's in particular what we think is interesting. That's where you have a large swathe of companies that have not yet necessarily addressed the reform that they can do, the restructuring they can do to their balance sheets.
Bain Group's head of multi-strategy equities, Ed Cole, there on the opportunities he's still seeing in Japan. And, of course, 11:29 a.m. in Tokyo now. I don't know if these traders are going to have much of a lunch break, Dave. Or maybe they have to just quickly eat something quick and then get back to their desk because, you know, this BOJ decision, imminent, right?
Could come out any time now. I hope they had either a healthy and hefty breakfast to tide them through. And by the way, right, so it's not just skipping the lunch break, right? Because coming out of the lunch break, too, we then get into the press briefing where probably some of the more juicy stuff is coming from as well.
And the global investors are probably staying up late watching this press briefing, too. It could be an all-nighter, really.
There we go. And thank you, by the way, to our viewers just joining us right now, joining us from the U.S. and Europe. Welcome to the show. You're watching the China show. We're in BOJ Watch, though. So do we finally get that rate hike, right? So it looks to be, and based on all the reporting that's come out of Japan, it's going to happen today. Is it one and done, though? And certainly the messaging has been fairly clear, and clear enough for a long time, that swaps actually have stopped moving. So swaps expectations of where the 10-year yield is going to be, suffice to say here. We've been looking at this yellow line, that's the 10-year swaps right now, ever since the Fed started hiking interest rates. And ever since that time, of course, in 2022, that's actually started, as you can see, to diverge from the 10-year yield, and that gap has actually widened. In fact, it's widened to quite a distance and spread here. Each and every time we did get speculation that the BOJ might need to move and was forced into some policy changes on the back of what the Fed was doing. What's interesting these last few days, amid this barrage of news coming out of Japan and the BOJ might be doing something, is actually the opposite. Maybe a sell in the news situation here. That spread, as you can see, has narrowed all the way back to levels of 2022. So maybe one and done, and then we can talk about what's next after everything that's announced today. That's the bond market. That's the bond market. The currency might be different because the currency's been trading at 149. It's been well behaved, and the overnight implied vol, and obviously you measure that from yesterday going into today, at 18, it actually takes you all the way back to December. So we actually could get some fireworks based on at least expectations and hedging that we could get some movement here when you look at overnight yen swaps. So we've had 2 meetings, BOJ meetings, before the one that's wrapping up today. One was in mid-January, and the other one, where expectations were for a possible change back then, was back in December. We're back to levels of that time about 3 or 4 months back. Yvonne.
All right, and really what parts of the market are going to benefit from a potential move? Obviously, the strong wage increases that we heard last week from unions and the like may be the trigger needed for really what's been going on when it comes to the small cap space, which have been struggling to catch up with some of the large caps in Japan. And these firms have really been hobbled by sluggish consumer spending for years. Let's bring in Hideyuki Sano, our senior Asia stock reporter, joining us from Tokyo. So, Hide, first of all, how are investors looking to trade on the Shunto wage negotiation results?
Hi there. So, first of all, the number was quite surprising. The increase of more than 5% is something beyond many had expected only just a few weeks ago. So this is likely to change some investor thinking about what to trade on after the BOJ saga. And I guess one key area to focus is small cap shares in Japan and other domestic demand-oriented companies. These shares has been quite sluggish so far this year. If you look at companies like food companies, train operators, or airline companies, their shares have risen only something like 2 to 5%. And small cap shares have risen less than 10% so far this year, and that's half of the biggest companies. And Topic Score 30 has risen almost like 20%. So we're talking of a really big gap here. So some people might think that it's time to rotate out of those big cap stocks to smaller companies and domestic demand-oriented companies.
Yeah, I was going to ask you too, what sort of valuations are investors looking at when they go smaller, on the spectrum of market cap in Japan?
Yeah, I mean, I think that's one of very interesting questions. So at the moment, small cap shares are trading at a discount compared to large cap shares. So their multiple is lower than large cap shares. Now, that is quite unusual in Japan. If you look at the history over the past 20 years, about 80% of the time, small cap shares are actually trading at a higher multiple. So if you think that the things will, if you believe in a mean reversion, then small caps look like a very attractive bargain at the moment.
Hideyuki Sano there, our senior Asia stock reporter. Thank you so much. And his piece, of course, on the Bloomberg. And maybe just to add to that, too, before I bring in Stephen Engel, and certainly, the small cap space is also where you don't get that yen exposure that you have with exporters in case, of course, the yen strengthens from here. Our earlier guest, of course, out of Man Group, who you heard from as well, almost record cheap, right? Record cheap valuations as far as almost any measure you can come out with on the Japanese currency, well, hedging aside. All right, let's bring in Stephen Engel, right outside the BOJ building in Tokyo. Steve, any moment now.
Hey, you know what? The clouds have parted. The sun is kind of peeking out. That means clearly that Governor Ueda and the Bank of Japan board is about to announce, obviously, what we've all been waiting for. We have to wait to hear from him personally until 3:30 local time for his press conference. But yeah, I mean, it seems to be a foregone conclusion that they will exit negative interest rate policy, as well as potentially scrap the yield curve control and also future ETF purchases. Let's get more on what you guys have been talking about. We've been sitting on the street here outside the BOJ listening to all your analysis, me and my guest, Sayuri Shirai, Keio University professor and also a former BOJ policy board member. So we just were listening to David talking about whether the yen swaps are indicating that this could be just a one-and-done hike. What do you think?
I think so, because Japanese economy is really weak. Their real consumption is dropping over the past 3 quarters. Real wages are dropping. There's no sign that the economy is really getting stronger.
So why are they hiking now?
I think they are sending signal that they want to rush. Ideally, they should wait until June, because the April data, the result of spring negotiation come up in June, so they could wait it. But I think they want to do it right now because it's still inflation is above 2%, and they want to take this opportunity to get rid of negative interest rate.
So there is sort of disinflation right now. It's coming down a little bit. It's at 2.2%.
Yes.
Was there enough evidence with the wage negotiations, the wage hikes that we're going to be seeing after the Rengo and the overall Shunto spring negotiations? Does that indicate to you that there is a virtuous cycle?
Not yet, because it's true that the wage negotiation probably ended up at a very high rate, 5% wage growth. But last year it was also very high, 3.6%. But the actual wages was just 1.3%. So because once you include small and medium enterprises, they are not in a position to raise wages because profitability is not high and the economy is weak, right? So this time 5% is only purely among large companies. So that's why they should wait until June data, but why they have to do it now? Right?
So if it's going to be one and done, what conditions do we need to see for them to hike again? Because they're not going to backtrack from this if they do hike, right? They've done that before. They've acted too prematurely, and then they had the political blowback.
To me, I think they cannot do a lot of continuous hike because economy is weak, right? A small and medium enterprise output gap is still negative. Right? There's no sign. You said inflation above 2%, but once you exclude, assuming that food prices and energy prices remain zero, current inflation is already below 2%. I mean, it's very difficult to say 2% is achievable in a stable manner.
You also don't think it's necessary to scrap the yield curve control, at least the 1% limit.
Okay. So I think yield curve control means, short end, minus 0.1%. That's they are likely to remove it. And the 10-year yield is set at 0%. That is likely to be removed. Now, so in that sense, yield curve control will be removed. But at the same time, they have a 10-year upper limit, which is set around 1%. That is more important, whether they get rid of it or maintain it.
And do you expect to hear that kind of guidance today?
I think they will say something. I think if I were Bank of Japan, because I don't want to have a lot of volatility for the economy, so I will maintain 1% as a upper limit. But there are some rumor that BOJ may get rid of it. Then how in what way they are going to continue the low interest rate 10-year yield? That is very challenging.
Right, and that's what we really want to hear is what is the post YCC policy going to be, as well as with JGB purchases. Yes. What do you expect there?
So I think Bank of Japan needs to continue to buy JGB because the supply side is growing, the government debt is growing, and and I think government is not really ready with this interest hike environment. So BOJ can do some small increase in the interest rate, but the very drastic changes probably it's too premature for the Japanese economy.
You also think that they should maybe change their metrics for their inflation target?
I think so in the end, because over these 10 years, they try to achieve 2%, and now it's above 2%, but it's not. It's clearly it's not a demand driven. It's a commodity shock, and yen's depreciation. So once those impacts are gone, the inflation is not going to be high. So it's not sustainable.
Right. So they don't want to necessarily, if they have that 2% inflation target, they have potentially with policy contradictions, right? So you think a range maybe is a better idea?
Yes, I always think so. So at this moment we can say 1 to 3%, including 2%, and they can review every 3 years. There are so many central banks in the world which adapt the target range. It doesn't have to be pinpoint 2%. And then once they do the pinpoint 2%, then they might have some contradiction with their flexible monetary policy.
What's your outlook for the yen? We talked about that is maintained pretty steady through all this speculation that it's a foregone conclusion. And yet, of course, the yen has not appreciated at all through this. Is that because of the Fed, really? And the dot plots there pretty much indicate they're not going to be easing anytime soon.
Yeah, so most important one is the Fed policy. That is a major contributor. But at the same time, let's listen to what Governor Ueda will say today at the press conference, whether he want to, whether this policy change will be just a one time for all, or are they willing to do some kind of more adjustment? And if, BOJ sends signal, this is just a one time for all, normal interest hike, then market may be disappointing, so it may not lead to the correction of yen's excessive cheap yen.
So you're kind of saying he can't be too dovish, otherwise he undermines his own decision.
Yeah, so it may go the opposite way, and but also he cannot be too hawkish because it's not consistent with Japanese economies.
So you were a former board member. How divided, or how many dissenters do you think there will be, and does it even matter? Because it looks like they're going anyway.
I think majority of people will support, because the BOJ already changed the communication tones. At the beginning, when the new governor came, they emphasized about achieving 2%, and the continuation of current monetary policy is absolutely necessary. But over these 2 to 3 months, they changed the tone, and they started to say, removal of negative interest rate, there's a virtuous price and a wage cycle, and the outlook of achieving 2 3% is possible. So they are sending a lot of very, very, confident, type signals. So I think they, at this moment, want to get rid of this negative interest rate because they know there's a lot of side effect for the commercial bank. So they want to take this opportunity.
What do you make of the Nikkei report? In addition to the scrapping of the yield curve control, as reported, they're also saying no future purchases of ETFs. Yeah. And is the more important question there is whether they hold on to existing holdings?
Yeah, I think selling the ETF stocks is very challenging. Now, get rid of this, ETF purchases. It's no surprise because they are not buying for more than 1 year. So it's just a symbolic, right? Yeah. But the selling, holding of an ETF is very challenging. I think they are not going to do it anytime soon.
All right. So as far as rate hike, one and done, you say?
I think so.
One and done. Okay. That might be the biggest surprise coming out of this meeting. And, of course, the policy statement that's coming imminently. And then, of course, further guidance from Governor Ueda at 3:30 local time. Back to you guys. David?
Yeah, there we go. First one in 17 years, perhaps the last one and only one in the next 17 years. Let's pivot back. Have a look at China right now. Just over an hour into the session. We opened lower, as you can see, and since about that time, of course, we've seen a rally across this market. And since that point, of course, at the peak about 40 minutes back, we've then come down as far as the index goes. Now, most sectors are down. Volumes on the lighter side. We've whipsawed. One specific sector, though, which you might see is energy, but I'll tell you anyway. On the back of this pivot and this pickup in energy prices globally, 4-month highs on Brent, we are seeing that specific CSI 300 benchmark, that specific subsector index, by the way, also pushing higher as well. Now, let's take a massive step back and look at this rally in terms of momentum. And certainly a couple of things in play. Might not be today because of what we're seeing. And thank you for the energy index, 2.3%. That's in play for the first time in several months, a 200-day moving average. And by the way, there's also RSI 14-day bottom of your screen. There's also a lot of momentum coming through here as well. And by the way, we haven't even breached a 70 level, which typically indicates that it might be time. It's probably gone too far too quickly. We're not even there just yet. At 66, a lot of people would say that's actually a fairly healthy read of momentum. Still very policy driven, and we'll see what these earnings look like these next 2 weeks or so. That's a look at markets right now. We're mostly flat, 3,600 right now on the CSI 300. Plenty more ahead. This is Bloomberg.
Well, UBS Group shares hit a 16-year high this month, capping off a remarkable run in the year since it took over its beleaguered rival Credit Suisse. Following a series of restructuring moves, the CEO, Sergio Armati, now aims to crack the lucrative U.S. wealth management market. Bloomberg's Samuel Etienne reports.
Who would have expected UBS shares to have soared since the bank took over its ailing Swiss rival Credit Suisse 1 year ago? Yet that's exactly what's happened, with the stock hitting a 16-year high in early March. Behind this, confidence in Chief Executive Sergio Armati's turnaround of the Swiss lender and integration of the two banks.
I think it's very important for investors to understand how we are connecting the dots between what we said in summer last year and in respect of our long-term plans.
Armati's goal is simple: to make UBS the undisputed global wealth champion and take on Wall Street rivals where they have the home advantage. In the US, UBS chief hopes to leverage former Credit Suisse clients in the US and manage their wealth, including those still building their fortunes. But catching up with these American financial giants will take time and come at a cost.
More than 50% of our cost is headcount, and there are duplications, but we try to do it over time.
European banks, including Deutsche Bank and HSBC, and even UBS, have previously tried to crack the US market and had to pull back. But this time, UBS aims to be the one left standing at the end of this round.
Right, there we go. Samuel Etienne there with UBS as the shares hit highs. Okay, we have something coming up here. In fact, just news on
Fidelity.
Yes. Ooh. Okay. So it seems that, well, the company is weighing cutting 20 China jobs as part of the global layoffs. And just we're getting more information here as far as what sources are saying, the number of layoffs is still being finalized, and the cuts may start in the coming days. Are you seeing anything specific?
The company did say earlier that they were going to cut 1,000 jobs globally this year. So perhaps this is part of what they're doing when it comes to the China business. But we've talked about how competitive the asset management business has been in China. It's been challenging just given the regulatory scrutiny that's been tightened and local competition as well. So it's not just them, right? We've heard from Vanguard, Van Eck, Matthews. They've also talked about having retreat from the mainland as well. So this is just kind of part and parcel to that, too.
Yeah, it's worth noting, to your point, we heard from Fidelity that no decision has been made. A review across all markets is still ongoing, and their longer-term commitment, to your point, Yvonne, to the Chinese market remains unchanged.
All right, we got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. Time of the day to look at your China brief. Look at the stories making headlines in newspapers and also online. The China Securities Journal says a series of guidelines from the regulator to tighten oversight of IPOs will impact the share issuance market. Now, the report says new rules will not allow low-tech companies to pose as high-tech firms, so capital market support goes to places where it's actually most needed. It says at least 67 IPOs have been terminated this year. That's compared with 43 in the same period last year. Now, a commentary in the Economic Daily on other things here, by the way, says it's necessary for China to start a new round of fiscal and taxation reform. It's partly due to the funding squeezes many local governments are currently facing. And the commentary also calls for consumption tax reform and tweaks to taxes, including in green and also digital economies.
Yeah, and online, obviously, one of our top stories has been, when it comes to Evergrande, been fined by China's top securities regulator. That's been trending on Weibo this morning. The defaulted developer is accused of falsely inflating revenue by more than $78 billion in the 2 years leading up to its failure. Evergrande's founder, Hui Kaiyan, and his flagship unit have been fined over 4 billion yuan. Hui also banned for life from capital markets activities. Now, some Weibo users seem pleased with this verdict, agreeing that he should be severely punished. Others, though, are wondering who will actually pay for his fine, considering that Evergrande has somewhat $300 billion still in liabilities.
Okay. Yeah, still the same dynamics of where to find the money.
Yeah.
Okay. Well, that's the China brief for now. We're still, and again, we're pivoting back to the BOJ because any moment now, we should be getting, of course, that decision, and we are entering that sort of time window when typically they do drop that decision, and you're laughing. Why?
Oh, no, because it just, it could be happening anytime, right? Yeah. So let's go. We've been talking about this for days now. Local media seems to suggest it's going to happen. I think everyone's just kind of waiting for it to happen. And then what, right? What does this mean? Of course, is it just the pace of course, tightening? If you can call it that, what is that going to look like? Also, when it comes to support of bond markets and buying of bonds, what's the pace of that going to be? And is that going to be supportive for JGBs, too, moving forward?
Yeah, what do they do then with that mountain of JGBs that they still hold, right? So lots of policy tweaks that they could introduce. They could just pull the Band-Aid and just get rid of everything right now. And also what that voting looks like, what the tone looks like from the press briefing. So markets are looking like this ahead of that decision. And by the way, you can turn to your Bloomberg for more on this. TLIV go. Japan's been the land of the rising stock market. It's a land of the rising sun. Will it be the land of finally a rising interest rate? That's it for us, the China Show. Bloomberg Markets is next. Stay with us. You're watching Bloomberg.